All right, listen up. Something huge is happening in the world of crypto, and it's not what you think. There's a wild story going around saying a big shot from Wall Street, a guy named Tom Lee, single-handedly swooped in and saved Ethereum from disaster. Sounds like a Hollywood movie, right? But here's the kicker. That's not the real story, not even close. When you peel back the layers, you find something far more ambitious, way more daring, and honestly, a whole lot riskier than a simple rescue mission. We're talking about the biggest bet ever placed on Ethereum by a major financial player. A multi-billion-dollar gamble that could either rocket crypto into the stratosphere of global finance, making it a permanent fixture, or it could unleash a level of risk we've literally never seen before. So, buckle up because today we're going to pull back the curtain on this whole situation. We'll uncover the truth behind this Wall Street legend's massive play and break down his absolutely mind-blowing predictions for the future of crypto. First, a quick reality check. Did Tom Lee really save Ethereum? The short answer is a resounding no. Ethereum, the world's second largest crypto network, has always been chugging along just fine. It's done exactly what it was designed to do without any major hiccups. In fact, unlike some other crypto networks out there, it's had zero issues with downtime or pesky technical glitches. Tom Lee himself has even pointed this out. So, where did this dramatic rescue mission narrative come from? It turns out it's a massive misunderstanding of what's actually going on. To get the real scoop, you first need to know who this Tom Lee character is. He's not some digital native who grew up coding. Tom Lee is a total Wall Street veteran, a seasoned strategist with over 25 years of experience under his belt, before going out on his own and co-founding his own research firm back in 2014. What makes him stand out? He was one of the very first big-name Wall Street analysts to actually take Bitcoin seriously. Think about that for a second. Back in 2017, when Bitcoin was trading for just around $2,600, Lee published a groundbreaking analysis. He laid out a way to value Bitcoin, seeing it as a potential substitute for gold. He even predicted it would hit $20,000 by 2022. And guess what? He was almost right. Actually, he was pretty conservative because Bitcoin ended up skyrocketing past $55,000 in early 2021. This brings us to the real story, the one behind the saving Ethereum myth. This isn't a rescue. This is an acquisition. It's about a company grabbing a huge piece of the Ethereum pie. Here's how it all went down. On June 30th, 2025, Lee was appointed chairman of a company called Bitmine Immersion Technologies. Before this, Bitmine was a fairly low-profile Bitcoin mining operation. But that quickly changed. The moment Lee stepped in, the company pivoted, making a huge strategic shift. They announced a massive private placement to the tune of $250 million. And this wasn't to buy more equipment to mine Bitcoin. Oh no. This was to acquire a boatload of Ethereum for the company's own cash reserves. And the list of investors who piled into this deal, it reads like a who's who of venture capital and institutional finance. We're talking big names like Founders Fund, Pantera, Kraken, Galaxy Digital, and even ARK's Cathie Wood. All of them jumped in. What followed was one of the most aggressive buying sprees in the history of crypto by a major institution. In just a few weeks, Bitmine quickly snapped up over $2 billion worth of Ethereum. And by September of that year, that number had exploded. They had amassed over 1.8 million Ethereum tokens, worth an absolutely mind-boggling about $8 billion. This instantly made Bitmine the largest corporate holder of Ethereum in the entire world. And get this, it also made them the second largest crypto holder of any kind, right behind Michael Saylor's company. To put this into perspective, Bitmine was accumulating Ethereum at a pace that was about 12 times faster than Saylor's company initially stacked Bitcoin. So you see, this isn't some heroic rescue mission. It's more like a calculated, aggressive move to secure a massive chunk of Ethereum supply. So this begs the ultimate question. Why? Why is a highly respected Wall Street veteran leading a multi-billion-dollar charge to accumulate as much Ethereum as humanly possible? According to Tom Lee, We're witnessing something he calls the Wall Street convergence. He believes that the entire financial services industry, everything from banks to trading firms, is all in the middle of a massive shift. They're all moving onto the blockchain. And the main thing kicking off this huge shift? Stablecoins. Lee actually calls stablecoins the chat GPT of crypto. That's a bold claim, but he points to their viral adoption by everyday people, by businesses, and even by banks. They're everywhere. And what do you think is the backbone, the underlying technology for over 60% of this booming stablecoin market? That's right, Ethereum. Lee's argument is powerful. He believes that as Wall Street starts to tokenize trillions of dollars of real-world assets, imagine things like real estate, stocks, or even commodities, all put onto the blockchain, and as AI programs start to create their own token-based economies, the vast majority of all this activity is going to settle right on Ethereum. He sees this as one of the biggest opportunities, one of the biggest macro trades in the next 10 to 15 years. This isn't just a small bet, it's a foundational shift in how the world's money will work. And this deep conviction is crystal clear in his absolutely audacious price predictions for Ethereum. For the end of 2025, Lee is targeting an Ethereum price of anywhere from $10,000 to $16,000 per coin. And that's just the start. His long-term ultra bullish target for Ethereum is over $60,000 per coin. How does he get to these numbers? Well, he assumes that Bitcoin will hit his target of $250,000 and that Ethereum's value compared to Bitcoin's value will return to its previous high points, eventually reaching a ratio of about 0.25. And if you think those numbers sound crazy, get this, his long-term Bitcoin target is even bolder. He predicts Bitcoin could hit $3 million per coin. Now, it's easy to just dismiss these as wild, headline-grabbing numbers, but hold on a second. Lee has a pretty solid track record of making these bold, contrarian calls that actually pay off. He famously predicted the sharp, V-shaped market recovery back in March 2020. And he correctly called the S&P 500's rally in 2023 at a time when most other analysts were super pessimistic. Of course, he's not always right. His call for Bitcoin to hit $25,000 in 2018 was famously way too early. But his accuracy on the big, long-term trends has earned him a serious following on Wall Street. And now he's not just talking the talk, he's putting his own money and billions of institutional dollars where his mouth is. However, this is where the story takes a darker turn. Because a move this enormous, this incredibly massive, doesn't come without some serious risks and a whole lot of controversy. The first and most obvious criticism is that there's a glaring conflict of interest here. Just like Michael Saylor at his company, Tom Lee is the chairman of a company whose stock price is directly tied to the value of the asset he's constantly promoting in the media. Think about it. Every time he goes on TV and predicts a new all-time high for Ethereum, he's directly benefiting his company's balance sheet and, by extension, his own net worth. This situation has led many to seriously question whether his analysis can truly be objective. But the even bigger concern, the one that really keeps industry veterans up at night, is something called systemic risk. Nick Carter, a well-respected voice from Castle Island Ventures, has sounded the alarm here. He warns that these companies holding huge amounts of crypto on their balance sheets are creating a systemic risk for the entire industry. Even Ethereum's own co-founder, Vitalik Buterin, has issued a clear warning about the dangers of companies taking on too much debt in these crypto arrangements. He described these strategies as an overleveraged game, cautioning that if the market takes a downturn, companies could be forced to sell off massive amounts of their assets. This kind of sudden sell-off could destabilize the entire crypto market. Analysts at Bernstein, another big financial firm, have echoed this concern. They point out that companies that have taken on too much debt could be forced to sell off huge amounts of crypto into an already falling market. And what happens then? It absolutely amplifies the crash, making everything much, much worse. We even saw a preview of this kind of behavior. Bitmine, Tom Lee's company, announced a $1 billion stock buyback plan at one point. This move really bothered a lot of people in the crypto community. Instead of continuing to stack more Ethereum, the company was using its capital to prop up its own stock price. This raised some serious questions about their long term strategy and commitment to their core mission. So, in the end, the story of Tom Lee and Ethereum is definitely not some heroic rescue mission. It's the story of a Wall Street titan making the single biggest institutional bet in Ethereum's history. He's not saving the network, he's trying to own a significant piece of it. His core belief, his big thesis, is that Ethereum will become the foundational layer for a brand new tokenized financial system. If he's right, his investors will see absolutely astronomical returns, and Ethereum's place in the global economy will be solidified forever. But here's the flip side. If the market turns, if things go south, the sheer scale of Bitmain's holdings could act like a ticking financial bomb. Imagine a cascade of forced liquidations where everyone has to sell off their assets, dragging the entire market down with it. It would be a nightmare. This, my friends, isn't a story about saving crypto from anything. It's the story of Wall Street truly arriving in the crypto space. And with it, they're bringing all of their ambition, all of their massive capital, and all of their inherent risks. We are all, whether we like it or not, part of this grand experiment. Let's really hope it goes according to plan. All right, that's it for today. If you enjoyed this breakdown, make sure you hit that like button, subscribe to the channel for more insights, and don't forget to ring that notification bell so you never miss out on our next video. Thanks so much for watching, and I'll see you next time.